gold target, and this is probably early 2030s, is 20,000. And that looked great when gold was, 2,000 or 3,000. Now that it's run up here and may run up to 7,000 or close to 7,000 this cycle, 20 doesn't seem like a long shot anymore. It looks pretty reasonable. I think the likelihood is that 20 is going to have to be bumped up, that may be way short of where it ultimately goes. Silver, I have a target of 500. I am almost sure that that's going to prove too low, but I haven't changed it yet.
If you are going to let this happen, VanEck Fund says gold could go to 180,000 an ounce. That's their number, not mine. So let's just play this out. A $20 million bond you sell 20 years down the road, zero coupon. So you can bring back manufacturing at zero upfront borrowing costs. The rise of gold devalues the dollar. You can sell it to the world. If today you had to pay on that bond $5,000 an ounce gold, that's 4,000 ounces of gold you would owe today. But what if VanEck is right and it did go to 180,000? Or we see a revaluation. At 180,000, it's 110 ounces of gold instead of 4,000 ounces of gold. Right. So now at the end of the road, you have 110 ounces to pay. The dollar is devalued. You bring back manufacturing and you sell it to the world.
Investor David Hunter and precious metals expert Andy Schectman are fueling debate over bold gold and silver price targets for the early 2030s. With gold already surging beyond historical norms, projections of $20,000 per ounce no longer seem extreme. Some forecasts, including those linked to VanEck, even suggest a potential $180,000 gold revaluation scenario. Analysts argue such a rise could dramatically devalue the US dollar, reshape bond markets, lower real debt burdens, and accelerate global manufacturing shifts, while silver targets near $500 gain attention. Now, we present the clips from Thayer's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I haven't talked in a little while. Last October, I raised my silver target to 125, and it had been, I had been 75 for a long time. I raised it to 100. I can't remember exactly when. And then last October, I raised it to 125. Gold, I raised from 4,000 to 5,000, and then in October raised it to 5,500. Was obviously very bullish. This last sell-off that you just mentioned, I raised my gold target 6,800 after the sell-off. I mean, I didn't do it ahead of the sell-off. I actually called the sell-off. I was on a podcast the day before it started rolling over and said you could see a 30% sell-off in silver and maybe 10 to 15 in gold. And then when we got it, I said, that's cleared the air for another big advance. As much as it was parabolic in silver, I didn't react to it the way so many did, as this is the top. And I raised my silver target to 180. And I think you could see that by summer. I raised my gold target 6,800, as I said. So I'm extremely bullish. I think you are seeing, it corrected a little bit here recently, and the miners too. And I think, well, obviously we're still dealing with the sell-off. So it kind of went down, came back up some, went down some, went back down some. And now I think we're ready to go. So I think you're going to see that run to 180 in silver very quickly here in the next, 3 to 6 months. And gold to 6,800. I was always pretty much the high on the street in these things. More recently, I think there's a couple people, Michael Oliver, I guess, and I think is his first name, is talking, 300, 400, 500 silver. And I have that out there late this decade, early next. I don't think you get it this cycle. But I do think after what we've just witnessed and what I think we're about to witness, that 500 for me is probably a very low estimate for, the late 20s and early 2030s. They'll probably have to raise that, but I just don't, I could be wrong, but that'd be quite a run to see that happen this year. Gold is, some of it is, kind of catch up on all that money printing that we talked about over the last decade. Some of it is, there's a lot of stuff going on out there geopolitically, not just Ukraine, it's, Iran's obviously there. There's a lot of instability in the world, even though, I think Trump is doing a lot to try to calm things down. It may not seem like it while you're in the midst of it, but I think we're moving more that direction than the other. But still, while you're doing it, it does feel like there's a lot of turmoil out there that you got to guard against. There's so much out there in terms of, political battles and the New World Order things and stuff. So I think that all goes into the pot for gold. And obviously debt's through the roof. And there's a lot of people saying, I want gold. If we're going to just continue to expand money and continue to expand debt, I've got to have something that's, gives me grounding in terms of what can offset that. So I think that's all there. I am not in the camp that thinks we're imminently close to a reset or imminently close to the dollar losing its reserve status. We're still in the, I think, mid 80s or high 80s in terms of the, trade that's done with the dollar. So as much as they're making inroads and it's come down a little bit, it's not. I am, however, a bear on the dollar, and I've had an 82 target out there for a long time, and I think we could see that this year. So I am in, it's DXY, so I am in the camp that thinks the dollar is going to come down a lot here, and that will certainly boost that narrative that, gold's the only game in town. You need to have a hard currency. But I think on the other side of that, when we get the bust, the dollar could go from 82 to 120, and we're right back in the other side of that story. So I'm not in the camp that says reset or, gold-backed currency is going to be the thing going forward. That may happen, but it's probably still many years off. We won't get into it here. I don't think we have time, but I have a view that out of the bust, because of all the money printing, you'll have a very inflationary recovery cycle. I mean, very inflationary, where the U.S. could see 25% inflation. And then with the debt we have in the system, and again, not just here, around the world, it will lead to, I think, a collapse of the system we've lived under for, certainly the last 100 years, 100 years. So we could see something worse than the Great Depression, drawn out, and truly a collapse of the financial system around the world. In there, anything could come out of that. Hopefully it'd be something like a gold-backed currency and more, starting fresh and more stability, and because we've spent, I call this, we're in the last decade of super cycle, what I define as the long cycle between two depressions, the 1930s and what I think will be the mid 2030s. So it's basically 100-year cycle. And it's also what I think from post Great Depression, every cycle we've ratcheted up more. It's taken more, we've cranked it up. You've gotten inflation, and initially it didn't take that much to crank it down. Each successive cycle, it's gotten more extreme. So now we're at the point where, the ups are more extreme, and what it takes to bring the inflation down or bring the system back down into order, they overshoot, and it's a bigger event like the bust would be. So I think we're at that point where we're in the last decade of that super cycle. We're also at the end of what I call an 80, 90-year Ponzi scheme, because of all the, each successive cycle, the debt just went higher and higher and higher. And now it's accelerating at a much steeper rate.
Market strategist David Hunter has intensified his bullish outlook on precious metals, lifting gold targets to $6,800 and silver to $180 in the near term. Citing geopolitical tension, monetary expansion, and U.S. dollar weakness in the ICE Dollar Index X, Hunter sees further upside before a potential systemic bust. While he rejects an imminent reset or gold-backed currency, he warns that post-bubble inflation could exceed 25%, reshaping global finance and echoing dynamics seen after the Great Depression. Let's get back to the interview.
The Genius Act. It's diabolically genius. Now, Luke's, if I remember right, and if you're watching, Luke, I have nothing but the highest level of respect for you. I think you're maybe number one intellect in this entire industry. I think he said that gold would rise organically till 6,000 or 7,000. It's funny because Jeffries used to be, they bought Beige. Beige is who nominated us at one of the U.S. Mint authorized resellers. They were a primary distributor. Jeffries bought them. It was called Jeffries Beige. And then Jeffries left the gold market. They were a primary distributor for the United States Mint and many of the mints. They know gold very well. They said it's going to 6,600 before it takes a breather. Others are saying 7,000, but that's about the number he said it would go to, and then they would revalue it. Most of the gold held in central bank balance sheets across the globe globe. Most of them are called the gold revaluation, just for the heck of it. We have revalued gold, 1933 when Roosevelt did it, 1972 and 73 when Nixon did. The revaluing of gold devalues the dollar. This is the ultimate point. Now, you look at Stephen Meehan, the architect of the Mar-a-Lago Accord. He's at the Fed. He advocates for a weaker dollar. I've been talking about a weaker dollar forever in order to bring back manufacturing and pay off the debt. It's all part of my thesis that I'm either stupid or courageous enough to say publicly. I've said this for a long time, haven't got much in the way of pushback, talking to very smart guys. I was on a panel with Mark Moss, Brent Johnson, Nomi Prince, who walked backstage, and Nomi went like this to me. I almost fell over. I'm like, this is someone that I've been admiring forever. She said, this is amazing. And my thought is, first of all, how do you devalue the dollar? You don't devalue it against the dollar index. The dollar index is a basket of currencies that are devaluing against the dollar, because Triffin's dilemma says these countries over time have to buy dollars in the open market in order to transact global business. We don't trade enough with these people just through trade alone, they don't get enough in the way of dollars. So over time, they're constantly devaluing their currency against ours by buying dollars in order to weaken their currency for exports to us and for global trade, which is reserve currency. So measuring the dollar against the dollar index is measuring it against a melting ice cube. No, you measure it in gold. Last year, the dollar was down 10% against the Dixie, a basket of crap currencies, right? Mostly the euro, but it was down 80 against gold and 150 against silver. When Roosevelt confiscated gold, he confiscated 2067. It was 20, gave everyone 67 cents extra, which was a lot back then, and then devalued. You will see gold way higher. It is the only way out, because as my mentor, God rest his soul, Richard Russell, used to say, you can either inflate or die. Or, in this case, how do you produce he would say that because you couldn't produce your way up. We consume more than we produce. So how do we bring back that production? That's how you do it. And maybe Judy is right. And the fact that even though she didn't get elected or nominated, rather, the fact that she just sat down with Percent gives me great hope that maybe indeed, and the amount of talk about July 4th all of a sudden makes me feel like maybe they are on this path. We'll see.
That would be cool.
Higher. Luke is right. Whether it is done just by revaluing it the way they've done it before, or letting it go up as a offshoot of the Genius Act, which I think they will do, or both. He's right. It will be higher.
Gold revaluation is again at the center of debate as analysts discuss a potential move towards $6,600, $7,000 before a monetary reset. Firms like Jefferies, once tied to U.S. Mint distribution channels, have projected gold strength before any pause. Historical precedents under Franklin D. Roosevelt and Richard Nixon show how gold revaluation effectively devalues the dollar. Influential voices such as Luke Groman argue higher gold prices could strategically weaken the dollar to support debt restructuring and revive U.S. manufacturing competitiveness. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.